Ever wondered about the power of stock ownership? Stock represents more than just shares. It's a piece of the business itself. I'm research analyst Nick Antonucci. In this episode of Planning Priorities, I'll delve into the intricacies of stock ownership, from your percentage stake to the potential benefits, including capital appreciation and dividends. Stock represents shares of ownership in a business. Owners of stock, also known as shareholders or stockholders, actually own a piece of the company the stock represents. When you buy shares of stock, your percentage of ownership depends on how many shares you hold in relation to the total number of shares issued by the company. For example, say that company A has 1 million shares of stock outstanding. You decide to buy 100 shares. This means that you own a tiny fraction, or less than 1%, of the company. The primary benefit of stock ownership is the potential to share in the company's success. You do this in a couple of ways. First, if the company does well and is expected to continue doing so in the future, your stock shares may increase in value. This is known as capital appreciation. If your stock appreciates in value, you may decide to sell your shares at the higher price. If you do, you will have what's called a capital gain. Second, you may benefit from stock ownership through dividend payments. Many companies distribute a share of their profits to shareholders through dividends. You may choose to receive the dividend payment in cash or reinvest the proceeds to buy more stock, which will increase your share of ownership in the firm. However, investing in dividends is a long-term commitment. In exchange for less volatility and more stable returns, you should be prepared for periods where dividend payers drag down, not boost, an equity portfolio. Additionally, the amount of a company's dividend can fluctuate with earnings, which are influenced by economic, market, and political events. If a company does not do well, the stock's price may decline, dividend payments may cease, and you run the risk of losing some or even all of your investment dollars. Dividends are typically not guaranteed and could be changed or even eliminated. To help manage market risk, some investors choose mutual funds that invest in common stocks. These are pooled investments that combine shares of many different stocks into one portfolio. A stock mutual fund can provide greater diversification, spreading the investment risk among dozens to hundreds of stocks. Remember, diversification is only one method used to help manage investment risk. It does not guarantee a profit or protection against investment loss. Professional managers choose individual stocks for the fund based on its stated objective, which can be found in the fund's prospectus. The prospectus contains information about the fund's underlying investments, risks, fees, and expenses, and should be read carefully before you invest. You want to consider the investment objectives, risks, charges, and expenses before investing. The prospectus, which contains this and other information about the investment company, can be obtained from your financial professional. Investing in stocks and stock mutual funds can help you pursue your long-term goals. Mutual funds provide instant diversification, allowing an investor with a smaller amount of money to diversify among many stocks in a cost-effective manner. With individual stocks, you're going to need at least 20 to 25 individual stocks in at least 6 to 8 sectors to be aptly diversified. But with individual stocks, you can have better control over when to take capital gains and losses, and complete control over portfolio holdings. With either investment, you need to fully understand both the potential risks and rewards. The return and principal value of stocks and mutual funds fluctuate with changes in market conditions. Shares, when sold, may be worth more or less than their original cost. Before choosing any investment, review your financial goals, time horizon, and risk tolerance. Lastly, there are several other points to consider about the potential risks and tax obligations of investing in stocks and stock mutual funds. Consider speaking with a financial professional before making any decisions. If you need help creating your portfolio, contact the experts at Henssler Financial. We'll be glad to help. I'm Nick Antonucci with Henssler Financial. Thank you for watching.